Here's how Canadian banks rule the real estate market. Even if you have enough cash to buy a property outright, you'll be surprised that most people, they'll choose to finance a purchase. In fact, 99% of people, whether they buy their primary residence, investment, or vacation home, they need a mortgage. So why do they finance? Well, there's more to the story than just the interest rates. Let's break it down. Here's the deal. When the banks lend you money, it's not just about the interest rates. That's the obvious part. But behind the scenes, there's a lot more to gain. So the bank looks at term. It's 3, 5, 10 years. It's a fixed rate, variable rate. How much down payment do you put? Is it 5%, 20%? The banks also check your credit record score, the type of property you're buying, and they'll assess how riskier you are. The bank's goal? Minimize the risk while maximize the profit. Well, every year the bank releases a real estate forecast. And there is something you may know, that this forecast is meant to influence the buyers or sellers, how the market is going to be. Ironically, this forecast comes out in February when the banks are selling their TFSA and other GIC products. How ironic. Now, let's look into construction financing. Sometimes, if a project is completed, the buyers no longer qualify for mortgage because it took 5 years to complete. What is the bank choice? Well, either the buyer needs to put more cash or the bank needs to reassess their loan to value. So, to avoid these massive defaults, the banks have blank adjustment of property value, which essentially manipulates the books. So, here's the catch. This is neither legal or ethical. The takeaway? Don't just focus on interest rates. Mortgages are complicated, and understanding the details can save you time, money, and stress down the line. If you found this helpful, subscribe and stay informed. Get ahead of the game and know how to be in a real estate game.